Why trying to predict the stock market costs Americans more money than they think, and what actually works. 1. The most expensive guess you'll ever make. Here's the part almost nobody tells you. The average investor doesn't lose the most money during crashes. They lose it trying to avoid crashes. According to DALBAR's long-running investor behavior studies, the average investor has historically earned significantly less than the broader market, not because they picked terrible investments, but because they kept jumping in and out at the wrong time. It's basically the financial version of leaving the grocery store because the checkout line looks long, only to come back when it's twice as long because of inflation headlines. You open your investing app, see a sea of red, your stomach drops, your thumb hovers over the sell button, and suddenly every YouTube thumbnail screaming, "Market collapse!" feels like it knows your future. Spoiler, it doesn't. Markets move on information, emotion, and randomness all at once. The more certain someone sounds about next month's market, the more skeptical you should become. And the craziest part is that Wall Street itself can't agree on what's coming next. 2. Even Wall Street can't predict the S&P 500. Every December, the biggest banks release their shiny forecasts for where the S&P 500 will end the following year. Goldman Sachs says one number, Morgan Stanley says another. JP Morgan has its own estimate. Bank of America lands somewhere else. $4 billion research departments, 4 different answers. Some years they're close. Other years they're spectacularly wrong. In early 2020, almost nobody predicted the fastest bear market in modern history. By the end of that same year, almost nobody predicted how violently stocks would rebound. Then came inflation, aggressive Federal Reserve rate hikes, AI mania, and entirely new predictions. Markets constantly rewrite the script. You remember trying to beat your friends at Mario Kart by memorizing every shortcut? Imagine if Nintendo randomly changed every track halfway through the race. That's what predicting markets feels like. But believing predictions isn't even the biggest mistake people make. The next mistake quietly destroys far more wealth. 3. Inflation doesn't just raise prices, it changes how you think. Inflation isn't only making your groceries, rent, and coffee more expensive, it's also quietly hijacking your brain. Behavioral economists call it recency bias. When inflation dominates every headline, your brain assumes inflation will dominate forever. When everyone fears recession, your brain assumes recession is guaranteed. You start delaying investments because things should get cheaper soon. Months pass, markets recover, prices keep climbing. Suddenly, you're buying higher than where you originally sold. Congratulations, you managed to lose money while trying to avoid losing money. Inflation creates urgency. News channels know it, social media knows it, every terrifying thumbnail exploits it. It's like the early internet when every LimeWire download felt like either free music or a computer virus waiting to destroy the family PC. You clicked anyway because fear and curiosity always travel together. But missing one type of day matters more than every scary headline combined. 4. Missing the best days is financially devastating. Here's a statistic that sounds fake, but isn't. Missing just a handful of the stock market's best trading days over decades can slash your long-term returns dramatically. The problem? Those best days often happen within days of the worst days. You sell after panic. The rebound arrives before your emotions recover. By the time headlines say things feel safe again, prices have already moved. Markets are like your group chat planning dinner. Nothing happens for hours, then suddenly everything changes while you're in the shower. Timing the market requires being right twice, when to sell and when to buy back. That's 2 nearly impossible decisions instead of one simple habit. If your brain is already connecting a few uncomfortable dots, keep following them, because the strategy that beats prediction feels almost too boring to work. If you're realizing how many money myths we've normalized, Save this video so you can revisit the strategy that actually survives inflation and market chaos. 5. Dollar cost averaging looks boring until you see the results. Dollar cost averaging sounds painfully unexciting. Invest the same amount every month. That's it. No crystal ball, no prediction, no secret indicator. Whether inflation is high, markets are booming, or everyone online is yelling about the next crash, you keep buying. Some months you buy expensive shares. Some months you buy cheap ones. Over years, the average price smooths itself out. It's basically meal prepping for your investment portfolio. Nobody brags about it on Instagram, but it quietly works. During volatile periods, regular investing removes the emotional pressure of deciding when the perfect moment arrives. There usually isn't one. Warren Buffett didn't become one of history's greatest investors by correctly predicting every recession. He became wealthy by staying invested while everyone else was panicking. But consistency only works if you survive the biggest psychological trap of all. 6. Your brain is fighting against your portfolio. Evolution didn't prepare humans for investing. It prepared us to survive predators. Losing money triggers many of the same stress responses as physical danger. Your heart races, your breathing changes. You refresh your brokerage app every 15 minutes like somehow the numbers will apologize. They never do. Loss aversion means losing $1,000 feels roughly twice as painful as gaining $1,000 feels rewarding. Add inflation headlines, recession fears, social media doom posts, and suddenly your perfectly reasonable long-term plan disappears overnight. Remember when your internet disconnected because someone picked up the house phone? Investing during market volatility feels exactly like that. Constant interruptions convincing you something is broken, even when it isn't. The investors who usually win aren't the smartest. They're often the ones who interfere the least. And the final lesson explains why that boring approach keeps beating prediction after prediction. 7. What actually works when nobody knows what's next? The uncomfortable truth is that nobody, not economists, billionaires, influencers, or Wall Street, knows exactly where the market will be next year. Inflation may stay elevated. It may cool faster than expected. Interest rates may rise or fall. New technology could ignite another bull market. A geopolitical event could trigger another correction tomorrow morning. You cannot control any of that. What you can control is remarkably simple. Invest consistently. Diversify broadly. Keep emergency savings so you're not forced to sell during panic. Ignore prediction addiction. Let compound growth work over decades instead of obsessing over weeks. The greatest investing advantage isn't predicting tomorrow. It's surviving long enough to benefit from the next 20 years. Because history keeps repeating one brutal lesson. People who constantly chase certainty usually pay the highest price, while the patient investors quietly let time do the work.